sure, uh, I'm sure all of you are almost prepared. I've also been on this journey before, but I rose to level 1 way back in 2017, and I was hijacked to come and help you with financial reporting and analysis. It was one of my strongest areas, and within the time frame that we have, we'll be able to go through some of the topics that you listed as topics that give you problems, like the financial reporting analysis, the inventory valuation, and then the taxes. And from experience, you have to understand the concept, because the question can be framed in so many different ways. And as an analyst, you're supposed to look at things from an analyst perspective. You are always supposed to think like what? An analyst. Okay. So without much ado, I'll mostly use the secret sauce, and then I have a couple of questions that I also look at. Hopefully we can make some headway, but I'm available for questions. If you have any questions at all, any clarification that you need. I'm already a practicing accountant, so definitely I'll give you an insight into some of the structure of the balance sheet, the structure of the P&L, the inventory valuations, and the earnings per share. So from experience, I want to know from many of you, how confident are you with the earnings per share calculation, earnings per share, diluted earnings per share, and anti-dilutive nature of the earnings per share. So I'll share my board, and we'll start from there. But anyone here with a particular problem with earnings per share, dilution and non-dilution there?
Yeah, hi, good morning. Please, sorry, I didn't really get the name, but I think
my name is Wise Sanku.
Wise.
Yes.
Okay, so I think when I was studying that the dilutive, I had a bit of a challenge there. So if probably you can brush through for us, I think that would be perfect.
Okay.
Yeah.
So I'm going to look at earnings per share. So this is how I will approach it. I'll be looking at earnings per share, the basic earnings per share, and then the dilutive earnings per share. And I don't think you write an FRA question without you get an earnings per share question. Okay. So for basic earnings per share, we are looking at distributing the earnings available over all common stock. So that is why the earnings per share formula is net interest or net income minus dividend, preference, all divided by the weighted average number of shares. So when we are looking out for basic earnings per share, we must pay attention to whether there is any preference dividend payable. And then the challenge you'll be facing is the weighted average number of shares. And this will be shares weighted according to time of the year. So it will include new issue, then repurchases, share repurchases. And then you also have to look at stock dividend. So for new issues, any new issue within, so let's say at the beginning of the year, number of shares was 1 million. And then 5th or 30th January, or let me just say January, because usually you're using the month. In June, there has been a new issue of 200,000 shares. The number of shares outstanding will be 1 million, which would have been outstanding for the entire year, 12/12, and then 200,000, which would have been outstanding as well, 6/12. So the weighted average number of shares that you use as your denominator will be 1,100,000 shares. Is that clear? And then repurchase, let's say there was a repurchase of shares of what? Share repurchase of 100,000 in September. How will it be accounted for? So I will go to Schweizer and demonstrate more of this. Then we use it to also explain the dilutive nature of some of the complex instruments that companies have in their capital structure. Okay. So as I was saying, the basic earnings per share will be the net income less the preferred dividend. And this is where you have to be very much, or you have to pay the effect of stock dividends and stock splits on the way the earnings per share is computed. So a stock dividend is the distribution of additional shares to each shareholder in a proportion to their current shares. And then a stock split is when the whole number of shares is split into new shares. So for example, a 2-for-1 shares will mean that a holder who had one will now have 200 shares. Now let's look at the stock dividend impact on the weighted average number of shares outstanding, because that is where most of the challenges will be. Johnson has 10,000 shares outstanding at the beginning of the year. On 1st April, so the dating must be very important. 4,000 new shares were issued. On 1st July, there was a distribution of 10% stock dividend. And on 31st September, there was a repurchase of 3,000. In determining the weighted average number of shares that will be used for the purpose of calculating the earnings per share, we have to look at the number of shares outstanding for the year. So there has not been any reduction, or we are assuming that this 10,000 shares stays throughout the year because we had that at the beginning of the year. And it will also enjoy the stock dividend. So all those who hold the 10,000 shares will have stock dividend. So we multiply by 1.1 here to give you the additional shares they will earn, and it will be outstanding for the entire year. So 12 over here, 12 over 12 to give you 11,000 shares. Then the shares issued as at 1st April will also enjoy the stock dividend. That means they will also gain additional shares because of dividends being paid in the form of shares. But that will be outstanding for only, it was issued in April. So the number of months is outstanding. Yes, Adia.
Hello.
Yeah.
Please, why are we multiplying the number of shares by 1.10? Because I thought we're looking at the individual shares and not the, let's say, the market value of the shares.
So the stock dividend is not market value. We are looking at the number of additional shares that are issued to you instead of giving you dividend in cash. So it's like you are buying additional shares. So instead of paying you dividend, they will issue you additional shares. So whatever shares you had, it will increase by 10%. Whatever number of shares you had, it will increase by 10%. And that also means that if we are looking at the valuation, your valuation also have increased by 10%. But here we are looking at just the number of shares. They are increasing your quantity of shares by stock dividend. That's how we are increasing it by 10%.
Oh, okay. So this happens only when there's stock dividend.
Yes, when there is a stock dividend.
Okay, so if we didn't have the 10% stock dividend, we just do the 10,000 times the 12 over 12.
Exactly.
Okay, thank you.
And so the stock dividend is not enjoyed by just those who had original shares. Even shares issued midway will also experience what? The stock dividend. That is why the 4,000 is also multiplied by the 1.1.
Okay.
And then the share repurchase happened. So it's a reduction in the shares. And that happened. So you look at the number of years that happened. So if the shares were repurchased on 1st September, that means from September to December, those shares were not there. That is why we have to prorate. From September to December, those shares were not there. That's why we needed to prorate them. And I think, yes, somebody's hand was up. So that should also be prorated to give you this weighted average number of shares outstanding. Are we good?
Yes, please, we are good.
Okay. So in calculating the basic earnings per share, you shouldn't have any challenge. The most difficult aspect would be you calculating the weighted average number of shares, right?
Yeah.
So this key final point, a stock split or stock dividend is applied to all shares outstanding prior to the split or prior to the split or dividend and to the beginning of period weighted average shares. A stock split or stock dividend adjustment is not applied to any shares issued or repurchased after the split or dividend date. Yeah, Godfrey.
Yeah, right. So we've looked at repurchases. I wanted to find out, do we have questions on this that has stock options? I don't know if I saw it, but
No, stock options will come in the dilution.
In the dilution, okay. All right.
Yeah. Okay. So most of the questions that you get, because of the complexity involved in dilution, that is where the examiner hits more. So let's quickly look at it. So before you identify an element that is likely to dilute the ownership, what it means is that that instrument in its current form is not shares, but there is that option, or there is that likelihood that the security or the instrument is convertible to shares if the option is exercised by the holder or the owner of that right. So those, you have to identify what the dilutive instruments are. That's where the stock option will come in, where employees are given the option to buy stocks at a predetermined price. So when we are calculating diluted earnings per share, we are assuming that all the dilutive elements are likely to take place at the end of the year. We are assuming if all these dilutive securities were exercised or were converted, what would have been the earnings per share? So it's an assumption. It doesn't mean that there will be an actual dilution. Warrants will also lead to dilutive earnings per share. Convertible debt, convertible loan notes that there is the option for the holder of the note to convert to shares is also dilutive, and convertible preferred stock. You know, preference shares, some of them are convertible from their preferred status to common status. If that instrument is also as part of the company's capital structure, then it will have a dilutive effect. And we expect all these instruments to decrease the earnings per share if they are exercised. So we don't expect you to have a diluted earnings per share higher than your basic earnings per share. So if by conversion any of these instruments are likely to increase your earnings per share, then we say these are anti-dilutive, and therefore you don't include them in your diluted earnings per share calculation. Are you getting the point? The diluted earnings per share is supposed to be naturally lower than what the basic earnings per share. Now, if in converting any of the elements or diluting any of the elements, it leads to increase in the earnings per share, then we say that it is anti-dilutive. So pay attention to this part very well. Anti-dilutive securities are stock options, warrants, convertible, all these ones, which by conversion, if we convert them or if we exercise them, it will lead to increase in earnings per share. Then they are anti-dilutive. Therefore, when you are calculating your diluted earnings, it shouldn't be included. Good. Now, so if you are calculating the earnings per share, the two elements that you use, how do you call it? The numerator and the denominator will all be affected by the conversion. So if you take each of the elements, if you take each of the elements of what the dilutive securities, stock options, is it going to affect the numerator? Is it going to affect the denominator? So if we take stock options, it will only affect what? The denominator, the number of shares outstanding. Warrants will affect, so the denominator, I will say that for denominator, all of them will affect it. But for the numerator will be affected by only the convertible loan note and preferred stock. So that alone should be at the back of your mind, that if I'm calculating diluted earnings per share, only convertible loan note and the convertible preferred stock will have impact on the earnings that will be used as the numerator. But all of them will have impact on what? The number of outstanding shares that we use to calculate. So let's go on quickly. So for convertible loan notes, we expect that when the bonds are or convertible loan notes are converted into shares, there will be an interest savings. So the net interest will increase by the after-tax interest. The net income will increase by the after-tax interest. Yeah, Michael, we have class at benchmark. So as I was saying, for the let me see. So as I was saying, the convertible loan and pref will affect numerator and the denominator. Stock options and warrants affect only the denominator. So for convertible loan notes, it will become net income less pref dividend if there is any. These ones are non-profit, non-dilutive or non-convertible pref, then plus after-tax interest, all divided by the weighted average number of shares, which will include the shares, the original shares plus the number of shares that each of the loan notes is convertible into. So the numerator is that the reason why we add back the interest, after tax interest, is that we are expecting that once the shares are the loan notes are converted into shares, the post-tax interest cost of these bonds will be a savings to the common stock owner, and therefore the numerator is expected to increase. Are we okay? Yeah, Kelly.
Yes, so I saw a question on the mock from the CFA Institute, and it had to do with the weighted average of shares in calculating the EPS. And I think for the beginning period in January, they had, I think, about 100,000 shares outstanding. Then sometime in June, they issued new shares, and in August there was a stock split of 2.1 2 to 1, and then in December, shares outstanding were, I think, 500,000. So I had a problem with working with the stock split in August, because I didn't know whether it was supposed to affect those that were issued before or the December one too, because
those that were issued before. Right, what they did was, did they include the stock split affect the December ones as well?
So the stock split was in August, and they gave end of period number of shares available.
Outstanding.
Yes, so I wasn't sure whether in my calculation I was supposed to add, because I knew for the January one, I'll do it, what's the name, 12/12 for this thing. June one, I'll do 6/12 times the number of shares. But the problem came with the stock split in August and the outstanding shares at the end of December that very year.
So the stock split is supposed to take effect on shares outstanding prior to the stock split, not post stock split.
Okay.
And then you add it to any additional issuance.
Okay.
Then that becomes your weighted average number of shares. But no stock split should affect shares issued after the stock split was done.
Okay. Okay. Thank you.
Okay. So I want to take an example of the convertible loan note. All right. So earnings per share convertible loan. So they said during 20x6, YYY Corp had earnings available to common shareholders in excess of 2.5 million and had 1 million shares of common stock outstanding for the entire year. So the net income is 2.5 million and had shares was 1 million. The basic earnings per share is earnings per share basic is $2.5. During 20x5, it issued 2,000 units of 1,000 par value bonds at $2 million. Each of these bonds is convertible into 120 shares. So there were 1,000 units of the bonds, 1,000 units. If they were all converted, each of them will be converted into 120 stocks. So that would be 1,000 times 120, giving us 120,000 extra shares. So the denominator will be what? 120,000 plus the 1 million. Sorry, it's 2,000. Sorry, 2,000. So that will be 240 shares. Then the numerator, the interest payable on the bond. The interest is always paid on the par value of the bond. There were 2,000 shares, 2,000 bonds at $1,000 par value, which will give you $2 million. Then times 5%, then times 1 minus T. That's what will add to the 2.5 million. And they will divide it by, so let me see. 2 million times 0.05 times the tax rate is 30%. So the income will increase by 70,000. So we now have $2,500,000 plus 70,000, all divided by 1 million shares plus additional 240,000 shares to give us the diluted earnings per share of 2.07, which is lower than the basic earnings per share. So it means that this convertible loan note is what? Dilutive. It's not anti-dilutive. So there's a way to help us to determine if the instrument is anti-dilutive or not. So the simplest way to calculate this is this formula here: convertible debt interest, the interest times 1 minus T over the number of shares. Or let's say convertible debt shares. So this will help you determine if the shares are what? Dilutive or anti-dilutive. So if this per share is greater than the earnings per share, then a convertible debt is what? Anti-dilutive. So if it is greater than earnings per share, then we say the loan notes are anti-dilutive. So we don't include them in the diluted earnings per share calculation. Is that clear? So these are some of the pathways you note to be able to determine if an instrument is dilutive or anti-dilutive. The same way with the pref. For the convertible pref, it is the net income less the pref dividend. Why are we subtracting the pref dividend? All divided by the weighted average shares plus the convertible shares, convertible shares. Convertible pref shares. Now, so to determine if the convertible pref is also anti-dilutive, it is the pref dividend divided by what? The pref shares. If it is greater than earnings per share, then it is what? Anti-dilutive. Is that clear? So are we all comfortable with conversion of what? Convertible loan notes and then convertible preference shares? Any question on it before we move to the warrants and stock options? Then we can quickly go to the ratios. Any question? Okay. I'll take that as we've been good. Now let's come to stock options. So for stock options, what you have to note is that the employees, usually employees who have options to convert or to buy shares at a price usually lower than the current market price. So what is expected is that if the employee exercises the stock option, let's say the stock option has an exercise price of $15, and the employee can buy 2,000 shares, or 200,000 shares at $15. If we assume that the option is exercised, it is not the $200,000 the 200,000 units of shares that we add to the denominator. We look at the current market price. The assumption is that if the employee exercises the option, the proceeds of the exercise should be used to purchase shares at the current market price. So if the current market price is, let's say, $20, we'll look at the proceeds of so this will be 2 times 5, 1.5 will be $3 million. $3 million worth of cash is what the company will get if the employee exercises the option. So what will happen is we will now use this 3 million to buy shares from the market. We assume that we are buying shares from the market and divide it by what, $20 and see how many shares the stock option is actually converted into at the market rate. So 3 million divided by what, 20. So the actual number of shares that we have to add to the outstanding shares in calculating the weighted average is 150,000 shares. Are we okay? So it's not that immediately the stock option is, we have a stock option, the entire number of shares under the stock option is added to the outstanding shares. No. The proceeds of the stock option when exercised should be used to purchase shares, or the assumption that we should use that to purchase shares in the market. And how many shares can we get? And that is what you add to the number of shares outstanding to calculate your diluted earnings per share. So to determine whether the stock option is also anti-dilutive or not, the formula is there that the average market price minus the exercise price, how much we sell it for, divided by the average market price times the number of shares. So if you do that and it is greater than the earnings per share, then you say it is anti-dilutive. So in this our case, $20 minus $15 over $15, over the $20 times 200,000 shares. Whatever we get, if it's greater than the current earnings per share, we'll say it's anti-dilutive. If it is not, then we calculate it, or we use it in calculating the diluted earnings per share. Yeah, Becca.
Hi, sorry to take you back.
Yeah.
Please,
Okay.
can you go over how you got the proceeds from the exercise? I'm a bit confused because, so if you go over, maybe you'll clarify for me.
Okay. So if there are 2 million, if the employee has the right to buy 200,000 shares for $15, how much will the company get? The company will get $3 million, right? If the employee exercises the stock option. That $3 million cash that the company has, because the company is supposed to issue that 200,000 shares to the employee. And then if the employee pays the $15 agreed, which is the exercise price, the company is going to get $3 million. Now, to calculate the diluted earnings per share, we need to buy the stock from the market. Assuming we want to buy the stock from the market, the $3 million, how much stock can it buy? So you divide it by the average market price to know the number of shares before you actually terminate. Is that correct?
Yes, please. Thank you.
Okay. All right. Any other question? I don't see much complexity. If so, the entire formula that you come across is this. Just, I don't know about you, but picture it. You have to have a pictorial view of the formula, because we all know the formulas will not be provided in the exam. So you have to understand what they are looking out for. What is the net income? Subtract the prepared dividend. That is the first portion for the, how do we call it? For the basic earnings per share. Then is there any convertible dividend? Add it back, because when the convertible dividends, the dividends are supposed to be converted, or the preference shares are supposed to be converted into common stock. Then the dividend that we used to pay will no longer be paid. That's why we are adding it back. The loan notes, remember that the loan note should always be tax adjusted. The interest on the loan note or the interest on the convertible loan should always be what? Tax adjusted. Because it is not the full effect that will come in as savings. So the tax adjusted interest on the convertible loan should be added. Then divide it by the weighted average number of shares you have, then shares from conversion, then shares from what? Shares from loan debt conversion, shares from preference conversion, and then the shares from stock options. Yes, Godfrey.
Thank you, Wise. So if I want to clarify something there, with the shares from stock options, whenever we want to know the number that we are going to add to the denominator, we can use the formula that you've put in the red bracket.
No, this formula is to determine. This formula is to determine whether the stock options are what, anti-dilutive or dilutive.
Okay. Then I think I lost.
Okay. So the number of shares to add to the weighted average number of shares should be the proceeds of the stock option divided by the average market price.
Okay, that would be like the 150,000.
That would tell you the number of shares. Yes.
That we are going to add to the denominator.
Yes.
Okay.
But the questions could come and whether they'll give you figures, but they want you to determine whether the stock or the particular security is dilutive or not dilutive. And
okay,
so then that you can just do this simple one.
Okay, so then if I may further, so this question that we saw, is it okay? So if I calculate it, it's 5 over 20 times, so that's going to give us like 50,000. No, let me calculate it. So like the 20 minus 5 all over 20. Kelly, hold on. Oh, let me see.
So Adia, how is it your nightmare?
It's just abstract. I don't know.
It's not abstract. It's so real. You are supposed to, you are an analyst, so you are supposed to take the financials of a company and analyze it. So this is what we are looking at. Okay, diluted earnings per share, because these all have impact on valuation. Remember what we are leading to as analysts is valuation. So you want comfort in the financials to be able to use it as your basis for your valuation. So for CFA, the FRA is more of analytics than what? The financial results. So that's why you pay attention to the ratios that we are calculating and the interpretation. So if you take earnings per share, if you know what you look out for, companies have complex financial structure. Now, the point is, as an analyst, what you are computing is what if all these instruments are converted into shares? What will be the impact on the earnings per share? Because earnings per share measures efficiency of how much each share value is generating in terms of profit. So don't let FRA be your nightmare. Don't even think of it that way at all. That alone will defeat you. So coming back to the guy who was asking about the how do we call it? The stock option. So that this formula is just to compute the anti-dilutive nature of the stock option. You know how your questions are asked, and pay attention carefully to the list and then most. If not, you'll be answering your own answer, or you'll be answering your own question in your own way. Yeah, I understand if you don't have a financial reporting background, but most of us didn't have, and we are where we are. So you just have to put your mind to it that you spend more time on it. And if you are having challenge, some of us are there to help you. All right? Are you writing, August?
Yes, please,
Adia?
24th.
Okay. All right, so let's move on quickly. Any other issues with the earnings per share? Any other issue? Alia, will you be comfortable answering any per share questions?
Not yet. Maybe weighted the average weighted number of shares.
In calculating that.
Yes, in calculating that, I think I'm confident now. So based on that, I can say yes, earning per shares, yes.
Okay, because there's no way you're going to write a question, you get an earnings per share question. There's no way you write and you won't get an earnings per share question. Okay. Now the common size analysis, common size income statement. This should be pretty simple. So we are trying to do comparison. Remember, as analysts, the key for us is comparison. Comparison with what? Peer companies, comparison with the industry. So to be able to compare two companies, you can only compare them on relative basis, not absolute. So for the common size income statement, every element on the income statement is measured against the revenue as a percentage of revenue, and that will tell you the efficiency of one company against the other. So if you are taking the cost of goods sold, it tells you the efficiency of how a company manages its input cost. So as a percentage of the revenue, that's common size. So for common size analysis, income statement common size analysis, we take every element of the income statement and take it against what? The revenue, and it has what? Interpretation, and interpretation is what you should be more concerned about. Administrative expense as a percentage of revenue. That means how much, because remember the revenue pays for every expense. Revenue pays for every expense. And if the revenue pays for all the expenses and there's an excess, that is when a company will have an operating profit. So we want to say that how much of our revenue is being consumed by what? Administrative expenses. If less of your revenue is being consumed by an administrative expense compared to another company, that means you are doing well against the other company. If your administrative expense or your research expense, if you have lower research expense against another company, it means that you are not investing into what? Research enough. And that may explain the increase in the cost of goods. So there is linkage in the ratios. If you have a lower research expense as a percentage of revenue compared to another company, it means your investment in revenue is less. And your investment in research is less. And when that happens, it is only a matter of time that you will not be able to control costs or you will not be able to increase your revenue. So in some cases, higher higher research as a percentage of revenue is desirable because it indicates how much investment is being done in research. So common size income statement, every element of the income statement is measured as a percentage of the revenue. Are we okay? And you can use it to do time series analysis. That means the same company but different time period. Is there what are the changes in the ratio when it comes to, or what are the changes in the percentage when it comes to what? They are common size analysis. So year one, what is the cost of goods as a percentage of revenue? Year two. So that will be the time series comparison. Then the cross-sectional one is where we compare across, or we compare within the same industry or across industries. And that is the surest way of what? Comparing two companies, especially if they are not of the same size. Okay. Then the other ratios that are very common to us, we'll go to ratios soon, but we have the net income as a percentage of revenue. This is what The net income as a percentage of revenue is your net margin. So anywhere you hear the word margin, it indicates what? A comparison to revenue, something to be measured against revenue. All right. So I want to quickly, because we don't have much time, I want to quickly go to the measurement. Okay. By now, all of you may have learned about the structure of the financial, the OCI, the retained earnings, and all that. Is there any particular issue with that? Classifying and accounting for any element on the balance sheet? Do you have any particular problem? Not figures, but in terms of principle, how an instrument is accounted for under US GAAP and then the IFRS. Any particular issue with that, so that you skip that and go to the analysis. The fair value through P&L, fair value. So remember, instruments measured as what? Available for sale. Changes in their value will be passed through OCI, other comprehensive income. Instrument classified. So this is US GAAP. US GAAP will say that the instruments are classified as available for sale, but IFRS will say that the instruments are classified as what? Securities, fair value through what? OCI. Then there's so much similarity in there. Then held to maturity is also held to maturity here. And then held for trading will be fair value to P&L, fair value to profit and loss. Is that okay? So the asset and the classification determine its impact on the P&L. So changes in the value of available for sale should be passed to other comprehensive income, but changes in the value of instruments classified as held for trading should be passed to fair value to P&L. If an item is classified as held to maturity, that means that there will be no mark to market. It will not be fair value, and therefore the change in the value will not be passed through any aspect of financials. Is that okay? Anyone with issue with the classification? Hello? Okay. So I would like to go to investment property. So in terms of assets that throw more light on it. What when you say investment property, in terms of capital asset, let's say how do you call it? A building or real estate. Is that what you mean? Okay. So if you classify a real estate as what? Held for trading, definitely it means that it will be, remember, under IFRS, all investments are supposed to be classified as whether it is OCI, APM, or fair value through P&L. Any changes in those values will follow the way trading securities will also be accounted for. So if you classify and invest a property, plant, and equipment that you used to have as part of the operation, which is not for how do we call it, trading purpose, you reclassify them as an investment property, which means that you are classifying them to hold or to realize the changes in the value. It is the pass through P&L. So now let's go to the ratios, financial ratios, which is also one of the key elements that will come in your exam. Then you can go to cash flows as well. Okay, let's start with cash flow. Understanding cash flow statement. And cash flow statements, analysts are more interested in the cash flow statement than the normal accounting financial statement, because the business thrives on cash. So as an analyst, you should be interested in whether the company is generating enough cash to continue as well a business, because you are forecasting the future viability of this company. So we have cash flow from operating activities, cash flow from financing activities, and cash flow from what? Investing activities. These are the three types of cash flows that you have. And the examiner expects you to know the difference between the US GAAP and then the IFRS when it comes to cash flow statement. Now, under the US GAAP, the only thing that differs more is the treatment of dividend, or the elements where they differ, where the two standards differ when it comes to cash flow preparation, is the treatment of dividend paid, dividend received, and then interest paid, interest received. Okay. So according to the US GAAP, dividend received interest received, interest paid, all of these are what? Cash flow from operating activities. Then dividend paid will be cash flow from what? Financing activities. Is that okay? And the IFRS, there is an option to classify them as either operating or financing or investing, depending on where you are. But for US GAAP, it's strict that when you receive dividend, when you pay interest, when you receive interest, treat all of them as well, part of your operating cash flows. And it is only dividend paid that should be classified as financing cash flows. So let's go on. So let's look at the operating activities. So for US GAAP, these are activities, operating activities will include cash collected from customers, interest and dividend received, and then sales proceeds from trading activities, and then cash paid to employees. Outflows will be cash paid for other expenses, acquisition of trading securities, and then interest paid on debt or leases, and taxes paid. So for US GAAP, interest, dividend received, dividend interest received and paid, dividend received will form part of operating activities. Financing activity, they will see proceeds from sale of fixed assets, proceeds from sale of what? Debt and equity investment, and then principal received from loans made to others, typically for banks. Then outflows will be acquisition of what? Instruments, fixed asset, debt and equity, and then loans and made to others as well. Then inflows for financing activity will be principal amounts of debt issued. So if you issue loans and receive, it will be cash inflow for financial activities. And then if you issue stocks as well, if you pay principal, so pay attention here. Payment of principal is seen as well, financing activities, but payment of interest is seen as well, operating activities under US GAAP. And that's where the majority of the issues are. Payment to reacquire stock and dividend paid to shareholders, they constitute financing activities. So now the direct method of computing the cash flow, operating cash flow, that's where the variance usually comes in. So for the direct method of calculating the operating cash flow, it's simply the cash. How much cash was received from customers, how much cash was paid to suppliers, cash paid for operating expenses, cash paid for interest, and all others. Now, know that this list is not exhaustive. You can have much more other elements for a particular company. But for direct method, we are looking at exactly how much cash we generate from our operating activities. Remember, accounting is based on accrual. So even though you may have sold an item, you may not have received the money from the customer. So for cash flow statement, we are looking at the cash involved. How much cash have you received from the customer? How much cash have you paid to your suppliers in that particular period? We don't care whether the payment is for 3 years ago. What have you paid to your suppliers in this particular accounting period? Then we determine the cash flow. Now, the indirect method, that is where the issue is, and that's where you have to pay attention a lot. Indirect method tries to use the income statement and then prepare the cash flow from that income statement. So for the indirect method, we expect you to start from what? Indirect method. The operating cash flow usually starts from what? Income statement. So net income. Then you make adjustment based on what? The balance sheet. Changes in the balance sheet, changes on the balance sheet, and then some elements of P&L will be adjusted for. So let's look at the typical example. So if they say Seagate Supply Company has a net income of 18,788, and then the adjustments required, depreciation will be added back, depreciation and what? Amortization will be added back. Why? Because they were subtracted before we arrived at net income, but they were not cash payment. Nobody made a payment for depreciation, neither did we make a payment for amortization. So we add them back. Then deferred income taxes will also be added back. Deferred income taxes will be added back. Then increase in receivable will be subtracted. Why will increase in receivable be subtracted? Increase in receivable means the company is being owed more by customers. That means customers they bought on credit, but they have not brought their cash. So increase in receivable means more cash is tied up. So you reduce your cash flow by that increase in receivable. So increase in receivable will reduce your cash, but decrease will what? Increase your cash. So increase in receivable is a subtraction from the net income to arrive at cash flow from operations, but decrease in receivable is what? An addition to what? Cash. Decrease means customers are making payments, so you are receiving cash. Increase means customers are keeping your money, so your cash is reducing. Increase in inventory. Increase in inventory means you have bought new materials and cash is tied up in there. Cash is tied up in there, so it will also reduce your net cash flow from operations. Then decrease in prepaid expenses. Prepaid expenses decrease is an inflow. Why is prepaid expenses decrease an inflow? If prepaid expenses are expenses that you have paid for in advance of what? Utilizing the service. For example, licenses. You may have paid for a license, but you are yet to exhaust the whole license. So what will happen is that if there is a decrease in the prepayment, it means cash is staying with you. You have cash. So reduction in your prepaid expenses should increase your cash. But the same way, increase in prepaid expenses means that there is an additional cash committed to some license or something, some expenses, and that will reduce your cash. Increase in accounts payable. Account payable denotes how much you are owing people. So if you increase what you are owing people, it means you are keeping more cash. So increase in account payable should be an addition to the net income to determine the cash flow from operating activity. Increase in account payable is a plus because it means the company owes a lot and is not paying out their cash. So the same way it goes for decrease in account payable means a reduction in cash because you have paid out money to reduce how much you owe suppliers. Right? Increase in accrued liabilities. Accrued liabilities are liabilities that you have consumed the service, but you are yet to pay for them. For example, ECG, you have consumed ECG, but you haven't received the bill, so you haven't paid yet. But based on accrual accounting, you would have accrued for it as a current liability in your account. Any increase in this accrued liability means that cash is staying with you, and therefore it's a plus. Any decrease in the accrued liabilities means that you are paying out cash, and therefore your cash from operating activities will reduce. So for the indirect method, it starts from the net income and then adjustments for both income elements and balance sheet changes. So for the net income adjustments, depreciation and amortization, it is not the change in depreciation and amortization that is what added back. It is the depreciation and amortization for the year. Even provisions, if you do provisions, you add it back because you have subtracted your provisions, which means that you are assuming cash was paid, but no cash was paid. So you add it back. Are we okay? So for indirect method, we just need to know what elements to adjust to arrive at the cash from operations. Okay. Any issue so far? Any particular challenge anyone has with what the indirect method of cash flow? Hello. Any particular challenge with the indirect method of cash flow?
Yeah, hello, Wise.
Yeah.
Yeah, Godfrey, yeah, sorry to drag you back, but it's still on this indirect thing. I think in your submission you were talking about this US GAAP and the IFRS. Now, so I wanted to find out. So I put it down. So under the US GAAP, we have discount received, interest received, and interest paid under CFO. That's the cash flow from operating operating activities, and the dividend paid will be cash flow from financing activities, right?
Yeah. Dividend paid will be cash flow from financing activities.
Okay.
But dividend received will be operating cash flow.
Fantastic. But how about for IFRS?
IFRS, there is, so for the IFRS, there is, let me see the decision. There is a choice to classify interest paid as what from financing or operating activity, depending on the expense, whether it relates to a financing activity. If it relates to, how do we call it? Depending on the nature of the transaction. So that what we are saying is that with the IFRS, there is a flexibility with how interest is treated and dividend is treated. But with US, it is strict. So if you see under IFRS an interest payment classified as a financing activity is correct. But with the US, there is no such thing. It's strictly by this. It should be under operating activity. So that's why that's why more emphasis is placed in the syllabus on the US GAAP, because that flexibility is not there. So you have to know how the US GAAP treats it. Because for the IFRS, it can be this or it can be that.
Okay.
Yeah.
So that means that if you have any question that has for IFRS, you can put it anywhere we would want to.
Yes. Yes.
Okay.
But most of the questions, they tackle the examiner try to hammer on where the controversies are.
Okay.
So for typical cash questions, they will want to pay attention to the US GAAP, because they know that's where you can have it wrong. Are we okay?
Yes, please. Right. Thanks very much for the clarification.
So if you see this question 11, for example, where are dividends paid to shareholders reported in the cash flow under US GAAP and under IFRS? Under US GAAP, we know that cash dividends paid to shareholders are purely on financing activity, right? But here under IFRS, you can see it as either operating or financing activity.
Yeah. Thanks.
Okay. Now, any peculiar challenge with cash flow? Because I was told that somebody listed cash flow statement as an issue for him or her. Any peculiar issue with cash flow? What I believe that what the examiner will be testing on usually is how you report individual changes in an indirect method. So, for example, if there was in the net income, there was profit on sale of assets. If there was a profit on sale of assets, that wasn't the cash. So you subtract it back. You subtract it out of net income and bring in then the proceeds of the sale of the asset will be captured under investing activities. Are you getting my point? I'm saying that for a typical example of sale of assets, when you sell an asset, maybe because of accounting measurement, there will be profit on sale of assets. That profit on sale of assets would have been included in the net income that was arrived at the end of the year. So what you do is that you subtract the profit on sale of the asset, but the proceeds of the sale of the asset will be recorded under, how do we call it? Investing activities. Is that okay? So let's say, for example, here, gain on sale of assets, gain on sale of what? Machinery. This gain on sale of machinery would have been included in the net income for the year. All right, net income for the year. So in this question like this, they didn't give us net income, but they gave us the net income margin. So the net income margin is 25% of the sales, 1,500. That becomes our net income, and and then we can start the calculation from there. 25% of the sales will be the net income. Then what will happen is depreciation will be added. So for this particular question, to get cash flow from operating activities, the net income will be 25% of 1,500, which will be the net income after tax. So 25 times 1,500. That's 375. And then increasing, then this depreciation will be added. Depreciation will be added 150. Then there will be gain on sales will be subtracted, gain on sale of machinery will be subtracted 30. Then the increase in inventory will be subtracted in inventory. Be subtracted, which is 100. And then increase in account receivables will also be subtracted, which is 50. Then there is a decrease in account payable, decrease in account payable, decrease in account payable. That means we paid out cash. So that is 70. That will also be what? Subtracted. So this will now give us our cash flow from operations. So 375 plus 150 minus 30 minus 100. 375 plus 150 minus 30 minus 100 minus 50 minus 70. So 275. 275 will be the answer. So the controversial item here is the gain on sale of machinery. So when there is a gain on sale of machinery, the accounting principles will require that you debit, you credit your income with the gain on sale of the asset. But for cash flow purposes, the gain on sale of the asset should be what subtracted because it should have been added. The same way if there to be a loss on sale. Yes, Godfrey.
Okay, so I was waiting for you to land so that I can ask my question.
Okay.
I don't know if you are done.
Okay, so if it were to be a loss on sale on the machinery, we would have needed to add it back. But the proceeds from the sale of the machinery would have been taken care of under our investing activities. So Godfrey, go ahead with your question.
Okay, so I remember and see somewhere. So at which point do we have to add back tax?
You add back.
I think we add tax to the net income. I saw somewhere there was like, was it deferred tax or something, and they added the tax back.
Yes. The deferred tax
Okay, so
you add back.
It's okay, but is there
tax payment itself will be is accurately accounted for.
okay?
But remember the deferred tax is the result of what accounting. The income tax expense is not necessarily the tax you have paid.
Okay.
The difference between the tax you have paid and then the tax you should pay is what is on the deferred tax liability on the balance sheet.
Okay.
Yes. So the income tax expense is not the cash payment.
Okay. So, but the fact that we have deferred tax, that means that we can also have like say prepaid tax or something.
Prepaid tax. No, you can't
I don't-
prepay tax. Nobody prepays tax ahead of time.
Okay. I was just thinking that. All right. Thank you.
Yeah. So now the converting indirect to direct tax. How do you go about it? Now, to direct tax, it means that you are going to compute 111. So you need to get the cash paid or cash received from customers and then cash paid to suppliers. Okay. So for that one, you begin with the net sales from the income statement. You pick the sales from there. So cash flow, cash collection from customers, net sales, and then you subtract increase in as receivable less increase in what receivable, because it means that the people sold, but they did not pay receivables. Increase in receivable is subtracted, and then what? You add any increase in an earned income. An earned income is where customers pay in advance. So, for example, companies like Apple, when you pay for subscription, they try and they treat it as an earn. The same way banks also treat payment of processing fees and others as an earned income. To increase in the earned income means you receive cash from what? Customers. So cash collection from customers is determined by net sales, adjustment for changes in receivables, and adjustment for an earned income. Then for payment of goods, cost of goods sold, you also do the same. The amortization, depreciation, and all that, you do adjustment for it. So converting indirect cash flow to direct cash flow means you are going to itemize collection from customers, payment to suppliers, and all others. And that one will be based on the information that you are given. Now, I want to look at the free cash flow before we go to inventory. Free cash flow before we go to inventory. So we have two types of free cash flow, and I'm sure you may have come across it in equity. So we have the free cash flow to firm, which is what? Cash flow available for distribution to both equity and debt holders. And then we have free cash flow to equity, which is cash available for distribution to only equity holders. So for the free cash flow to firm, there are two ways. You can either start from the net income statement. So net income, then you add all the non-cash charges. Those are depreciation, amortization, those ones that were not actual cash. Then you add back adjusted interest adjusted for tax 1 minus T. Then you subtract all fixed capital investment. That means investment in what? Capital assets, just as PP, property, plant, and equipment, fixed capital investment. And then you subtract working capital investment. Working capital investment is the changes in inventory, receivable, and payables. So we are trying to say that if we take the net income, we add back the non-cash charges, and then because you are determining the free cash flow to firm, which is cash flow available to both debt investors and equity investors, any payment to our debt investors should be added back. That is why we are adding the interest adjusted for tax. Then we take out the investments needed to keep the company afloat. This is the investment needed to keep the company afloat. The fixed capital. Fixed capital has to do with property, plant, and equipment that the company needs to invest in. And then working capital, so it has to do with what? Investment in the current aspect of the balance sheet, which is the current assets and liabilities, to keep the company afloat. So free cash flow to firm is the distribution or cash flow available for distribution to both equity holders and debt holders, or equity investors and debt investors. All right. Okay. Then we can also calculate the free cash flow from the cash flow statement, cash flow from operations. So you pick the cash flow from operations, then you add the interest adjusted for tax, 1 minus T, and then you subtract the fixed capital cash flow investment. Why are we not subtracting working capital investment? Because the cash flow from operations, from the cash flow statement, already includes what? Working capital investment. Working capital investment refers to receivables, payables, and then inventory. And the changes in this would have been reflected in the cash flow from operations. That is why we do not subtract the fixed the working capital investment from this one. So when we are calculating the free cash flow to firm from the cash flow statement, please do not subtract the working capital investment. Do not subtract the working capital investment. Is that okay? Then the free cash flow to equity. Here we are looking at the cash flow available to only equity holders. So here we pick the cash flow from operations, subtract the fees, because we want free cash flow to equity, there will be no adjustment for interest. With free cash flow to equity, there will be no adjustment for interest. We only take the free cash flow from operations, and then the fixed capital investment needed to keep the company running, and then we look at the net borrowing. Net borrowing. Is that okay? Any challenge that anybody has faced with the free cash flow when you are solving questions? Okay, with that done, then we can go to inventory, because inventory to present its own peculiar challenge. So the ratios that you need for inventory, or before that, let me go to let me come to this, the financial statement. The financial ratios. So for the financial ratios, all you need to know is the interpretation. Activity ratios will denote management of what? The company's financials, or the balance efficiency. So activity ratios measures efficiency. Liquidity ratios measures how a company is able to pay its short-term obligations, while solvency ratio talks about how the company is likely to meet its long-term obligations. So it's very important that we look at the explanation for the activity ratio. So receivables turnover will be the annual sales divided by what? The average receivables. So average receivables, if you were to have opening and closing balance of receivables, add them and divide it by 2. But in the absence of that, you consider whatever receivable given to you as what? Average receivables. Now, you also have to be aware of what? The days of sale outstanding. That means how many days is it taking us to collect how much you have sold to us, or you have sold to customers. So that one, you take the 365 days and divide it by what? The receivable turnover. So you need to know whether you are calculating receivable turnover or you are calculating days of sale outstanding. Is that okay? Days of sale outstanding tells how many days it takes for us to collect cash from the sales we have made. And the lower the days, the better. It shows that a company is efficient. And you have to compare it to other companies to make sense of it. So your questions, there will be a lot of comparison. It will not just be calculation. You may have to calculate for two companies and determine which one is performing better. Then we have inventory turnover days. Inventory turnover days, it is what? Cost of goods sold divided by the average inventory. And we can have, inventory turnover. And then we can have days of inventory on hand, how long our inventory is staying in our warehouse. That would be the inventory turnover, 365 days divided by inventory turnover, 365 days divided by inventory turnover. Good. It also measures the lower the better, because if it takes lower days or your inventories are staying with you for shorter days, it means that you are efficient in managing your inventory. Then payables outstanding. Payable turnover will be purchases. If in a question you don't have purchases, you can use cost of goods sold as well. The substitute purchases. Purchases over average trade payable. And the turnover days will be payable turnover days, or payable number of days of payable. How many days it takes us to pay our suppliers. Once the number of days payable is higher, it means that we are keeping cash. We are more efficient. Then the asset turnover is efficiency of how quickly you can turn your assets into what? Revenue. How you utilize your assets to generate revenue. And that will be revenue divided by average total assets. Then fixed asset turnover is what? How well you are using your fixed asset, your PP. How well are you using them to generate revenue? And then working capital turnover. So anytime they use the word turnover for assets, you have to take it as what? Revenue. So fixed asset turnover will be revenue over average net assets. And then net fixed asset, working capital turnover will be average, the revenue divided by average working capital. And here we multiply them in multiples. There are multiples. Liquidity ratios will be current ratio, quick ratio, and then the cash ratio. Please note the difference between the cash ratio and then the quick ratio. In the cash ratio, we do not include what? Receivables. In the quick ratio, we do not include inventory. In the current ratio, we include everything. Quick ratio, no inventory. Cash ratio, no receivables. We are looking at how quickly we can turn whatever we have into cash. And if the cash ratio is correct, it means that we have cash and marketable securities, T-bills that you can easily discount. And the higher your cash ratio, the better. Good. And then the defense ratio interval. Maybe some of you may have solved questions, but you don't come across some of these things easily. Defense ratio. Defense ratio is talking about your daily expenses. How much cash do you have to be able to finance your daily expenses? So the defense interval will be equal to cash plus marketable securities plus your receivables, all divided by your average daily expenditure. That's your defense interval ratio. Then cash conversion cycle. Cash conversion cycle. This will be the days. Use the days. So inventory days plus receivable days minus payable days. inventory days plus receivable days minus payable days. They will tell us how quickly our cash is converted during our sales process, or how quickly do we generate cash in our sales process. If it takes too much days if you have high cash conversion cycle, it means that it takes a longer day for you to generate cash from your sales processes, and it means a lot of capital is locked up in there. We have debt to equity ratio, which will be total debt divided by total shareholders' equity, by one of the very important metrics. What is the meaning of debt to equity ratio? It measures the use of fixed cost financing sources. So how much, what's the ratio of your debt to your equity? And the higher your debt to your equity, it means that your capital structure is highly geared. Then we have debt to capital ratio. That means we are looking at how much of the entire capital is being financed by what, or how much of the entire capital, what proportion of your entire capital can be attributable to debt. So your total debt per shareholders' equity. So debt to capital is different from debt to equity. Debt to equity is just the ratio between the debt and equity. Debt to capital is the ratio between the debt and the entire capital. The entire capital is made up of debt and then equity. So you add them there. Then debt to asset ratio is your total debt over total assets. And then financial leverage, very key, important, very key ratio for us. We'll be looking at it in the DuPont. Financial leverage is your total assets over your total equity. So if you have higher financial leverage, it means that much of your assets are being financed by debt. Much of your assets is being financed by debt. The interest coverage. So interest coverage will be how much interest is paid before tax. So you have earnings before interest and tax divided by interest payment. That is your interest coverage. How many times does your earnings before interest and tax covers your interest payment? And then EBITDA is the earnings before interest, tax, depreciation, amortization. So more or less cash. So debt to EBITDA ratio should be easy to compute. Fixed charge coverage, the earnings before interest and tax, and you add the lease payments and you divide it by what? Interest plus lease payment. So I want to quickly go to the DuPont analysis, which is something very crucial for your paper. So DuPont is trying to examine what the components or the things that make up the return on equity for investors. So ROE. So he's trying to first determine ROE as a function of what? Profit margin, then turnover, asset turnover, and then financial leverage or leverage. So DuPont is saying that the function, the return on equity for any investor is the function of profit margin, asset turnover, and then financial leverage. So once you have it at the back of your mind like that, you know how to, instead of trying to calculate, put the formula in your head, try to understand what it means. So profit margin definitely is the profit after tax divided by what? Revenue. Then the asset turnover is what? The revenue divided by what? Total assets, total average assets. And then the, how do you call it? The leverage is the total assets divided by total equity. Good. Okay. So then they further decompose the return on equity as a function of what? Tax burden times interest burden times what? Operating margin times the asset turnover times the leverage. So the lower the tax burden, what will cause the tax burden to be low? What is the tax burden? Tax burden is equal to the earnings, or let's just say profit after tax. Your profit after tax divided by your profit before tax. So what we are looking at is profit after tax divided by profit before tax. That is your tax burden. So the impact, the more tax you pay, what will be the impact on the ratio? The higher your ratio, right? So here, remember that the tax burden can also be computed as well. 1 minus P. This is also the same as your tax burden. So profit after tax divided by profit before tax is your tax burden. So if you pay a lot of tax, your profit after tax will be less. So let's say your profit after tax initially was 100. Then profit before tax was what? 150. So your tax burden will be 100 divided by 150. Now, if tax increases to, let's say, 20, or tax increases by $20, what will happen is that your profit after tax will reduce to 80 divided by what? 150. So the lower your tax burden, the lower the ratio, the higher your tax burden. That's what it means. The lower your ratio, the higher your tax burden. So the lower the tax ratio, the tax burden ratio, the higher tax burden. So how much of your profit before interest and tax is consumed by what? The tax. Because you pay tax out of profit before tax. Sorry. Yeah, how much is your profit before tax consumed by tax? So the profit before tax is 150. Profit after tax is 100. That means you pay 50 as tax. Then if you think your profit, your tax increases by $20, what it will mean that your profit after tax will now be 80, but your profit before tax is the same. So what that means is that your tax burden is even widening, which means you are getting what? A lower return on equity. So it's very important that you understand the implication. So tax burden is profit after tax divided by profit before tax. And the lower the ratio, the result of this, the lower the ratio, the higher your tax burden. That interpretation is very key. The next one is interest burden. Interest burden, and that DuPont is calculated as well. Your earnings before tax over earnings before interest and tax. So how much of your earnings before tax is being consumed by what? the interest. So that one too, the lower the ratio, the higher your interest burden. And then the last one here, operating margin, is your earnings. So operating margin will be equal to your earnings before interest and tax divided by your revenue. Operating margin is your earnings before interest and tax divided by revenue. So for DuPont, the 5-way analysis, or the 5-way analysis is simple. So the DuPont analysis, return on equity, the 5 ones, profit after tax over profit before tax, then times profit before tax over profit before interest and tax, times profit before interest and tax over the revenue, times the revenue divided by total assets, times the leverage, financial leverage. So that is total assets. How much of the total assets will be consumed by what? Is being funded by what? Total equity. The higher the ratio, the better. So your return on equity is made up of tax burden, interest burden, and operating margin, turnover, and then leverage. Good. So you must understand that the examiner could give you any of this and may not necessarily ask you to calculate, but they want you to know the impact on what ROE for any of this. Is that clear? Any question on the DuPont? Any question on the DuPont?
Yeah, hello.
Yeah.
Yeah, so please, can you just go over the interpretation of the ratios as to whether when they are high and when they are low, what it means to the return on equity?
Okay. So I was trying to use an example to explain to you. Tax burden increases when the ratio is lower. Tax burden increases when the ratio is lower. Or the impact, a lower ratio, so lower tax burden ratio means what? Lower return on equity, lower interest burden, lower interest burden, ratio will mean lower return on equity. Now, what results in this lower tax burden ratio is caused by higher tax payment, higher tax rate or tax payment. The same way, lower interest burden ratio is driven by what? Higher interest payment or interest rate. And then the higher your asset turnover, the higher your return on equity. And the higher your leverage, the higher your return on what equity. Is that okay?
That's it. Thank you.
Okay. Any other question on this one? Are we all comfortable with this one? Adia, you're okay with this one?
Yes, please.
Okay. All right, so let's look at
Hi,
yeah,
please,
our time
sorry.
is up, but
Can you,
yeah.
can you please go over that again for me? Sorry.
The what? The different.
Yeah, the movement in tax, the tax burden, and then the effects on the ROE.
Okay. So what I was trying to say is that the ratio itself, the lower the ratio, the lower the ROE. Okay. But the lower ratio is driven by higher tax rate or tax expense. So if you take the tax burden is being measured as what? The ratio of the profit after tax to profit before tax. And that shows how much of your profit before tax is being consumed by taxation. So that's why I use the example. If your currently your profit after tax is 100 and the profit before tax was, remember, it is profit before, you take your profit out of your profit before tax. So let's say your profit before tax was 120. It means that your tax burden is equal to the 100 divided by 120. And the ratio will be 83, 0.83, which is 1 minus t. So that if you were to take the tax 1 minus t, that's your tax burden. Now, if our profit before tax remain the same, the profit after tax now, or let's say next year, our profit after tax reduces to 80. To 80. What it means is that we calculate a new tax burden, which is the PAT is now 80 over the same profit before tax, which is what? 120. What will happen? The ratio will reduce. 80 divided by 120. 80 divided by 120 will give you 0.6. 0.6 or 6. Which means that you have paid higher tax. The only reason why your profit after tax will reduce from 100 to 80 when your profit before tax is 120 is because you have paid $40 as tax. So here your tax is 40. Here your tax was 20. Is that okay? So a higher tax will lead to a lower tax burden, which reduces the return on equity. So the ratios are multiplicative. So know that the higher the ratio, the higher the return on equity. But where the examiner will get you is the elements driving the ratios. Okay, the elements driving the ratios. A higher interest will lead to lower ROE. A higher tax will lead to lower ROE. A lower PBIT will lead to lower ROE. A higher turnover will lead to higher ROE. Higher leverage will lead to higher ROE. Is that okay?
Yes, please. Thank you.
Okay.
Yes.
So yeah.
Okay. I'm just trying to put all together and see if my understanding is right. Then it means that a higher tax regime and a high interest regime is a disincentive to equity investment.
Exactly.
Okay.
All right. Okay. So ideally, I should continue, but we were given only 2 hours. But my final advice would be that for financial reporting and analysis, majority of it is revision, is interpretation, and I will implore you to do repeat studies. That is how I passed my FRA. I was a chartered accountant before I started the CFA, but I never let that got into the way of taking the CFA as a different course on its own. So every material that I utilize, I read it more than 3 times to sit for the paper. So financial reporting was one of my best performing papers because I did back to back studies. So from now to the paper, financial reporting is heavily weighted. So I'll implore you to make sure that areas of inventory, earnings per share, areas of cash flow, I expect that you are able to look at it very well before you write. Okay. So inventory, for example, I know the LIFO thing. Anyone with a particular problem with LIFO?
Yeah.
Hi.
Actually, it's with the reserve.
Oh, the LIFO reserve.
How they link it to the.
Okay, so with the LIFO reserve, we've had the LIFO is treated. Remember, LIFO is not allowed under IFRS. So the LIFO reserve comes in when you are comparing the financial statement of a company that reports under IFRS and the financial statement under a company that reports with what US GAAP. So with the US GAAP, or if you are an analyst, you are supposed to do a reconciliation between the IFRS compliance company and a US GAAP compliance company. So the LIFO reserve is the difference between the LIFO inventory valuation and then the FIFO inventory valuation. So if you want to compare a US GAAP company with an IFRS GAAP company, add the LIFO reserve, all right? Add the LIFO reserve to, let me see, just to confirm. So let's see, just for us to demonstrate, add the LIFO reserve to the LIFO inventory, and then increase retained earnings. With what? The LIFO reserve. So in comparing US GAAP company with the IFRS, the LIFO reserve is the difference between the LIFO inventory valuation and the FIFO inventory valuation. So if you want to compare a US company a US company inventory with IFRS company inventory, the US company is under obligation to disclose their LIFO reserve. So add that LIFO reserve to the the inventory to be able to compare it with the inventory under an IFRS company. Is that okay? And then to balance the account, the LIFO reserve should also affect equity. So the retained earnings or the retained earnings part of the equity should be increased by the LIFO reserves. It's rather unfortunate we couldn't get time to do the LIFO, but it's very crucial that you get that part. Then the LIFO reserve adjustment to FIFO cost of goods sold is this. So FIFO cost of goods sold can be adjusted for. You want to compare. So the whole thing is that you want to compare a company that reports under US government, a company that reports under IFRS. The company under IFRS is not allowed to use LIFO. The company under US is allowed to use LIFO because so what they do is that their cost of goods will be valued at the latest prices, because last in, first out. Whatever came in last will be the first to be sold. So if they are doing their cost of goods sold, their inventory or their cost of goods sold will be valued by the latest cost prices in an inflationary environment. Because of that, they will achieve lower income for that reports with FIFO. So there will be a variance between the two, assuming all things are equal. So that's what they are saying, that to reconcile it, add the LIFO reserve to the LIFO inventory to compare it to that of what FIFO. And then you also increase retained earnings by the LIFO reserve. And then you also have to be aware of the LIFO liquidation. What is LIFO liquidation? LIFO liquidation occurs when a company that or that reports its inventory based on LIFO is no longer buying inventory, by now selling their lower inventory value, or they are selling their inventory. So they will sell their inventory, right? They are selling their current inventory, or the inventory that they use to value at LIFO. So what will happen is, because the inventory would have been valued at the earlier prices, the cost of goods sold now will be lower, and their profit will be higher. And such profits are not sustainable. So let me take it again. LIFO liquidation happens when a company is selling its inventory that used to be valued at LIFO. So the company is not increasing their inventory, but they are rather selling the inventory they had. And when you are selling, your cost of goods is supposed to be reported in the financials. The cost of goods sold will be lower because the inventory would have been valued at what? The earliest price. Because the inventory was valued at the earliest price, the cost of goods sold will be lower, resulting in higher profit. And we are saying that as an analyst, you should be aware of this LIFO liquidation, because if the profit is due to LIFO liquidation, the company cannot continue selling its old inventory without buying new inventory at the latest price. So when you say LIFO liquidation, adjust for it. That is what it is. All right. So all too soon our class is supposed to come to an end. It's rather a very short time, but at least I hope that you pick something, at least just one thing that could help you in your preparation. But I'm available if you need any clearance. Just WhatsApp me or send a message to the CFA site. I can assist you in any whatever way I can. All right. And I wish you all good luck. And please let your preparation be solid. Nobody gets to this CFA room and now having doubts. You are supposed to read the materials thoroughly. You are supposed to read the material very thoroughly. And I expect that when that is done, you will be able to excel. So I wish you all the best, and I'll be available for any inquiries. Thank you very much. So I see every site you can take over.